You're listening to Strictly Business Podcast with Lindsay Williams.
Last week in the United States of America, we had two inflation releases. One was consumer price inflation, that's the price of goods at the retail level. And also we had producer price inflation, that's the price of goods leaving the factory gates. One was embraced very nicely by the markets because it was seen to be benign. The other one was a little bit more of a surprise. With me now is an investment strategist at 91 in London, and that's Russell Silberston. Let's start with CPI if we can, Russell, because although it came out 5.4% year on year, the market suddenly took off after the figure because the month-on-month figure was quite a large drop. What did you make of it?
Yeah, no, hi there, Lindsay. Yeah, absolutely. I mean, the headline number, as you say, is still running at 5.4%, unchanged from last month. But the month-on-month, it did increase. It was up 0.5, but it slowed from 0.9, and it's the first slowing in month-on-month increases we've had for several months now. So the market took that to be quite bullish, and core underlying inflation, which excludes food and energy prices, also slipped back to 4.3% from 4.5. So that was seen as sort of confirmation that inflation should be peaking somewhere around here, and thus we've got a good reaction.
Yes, indeed. It's all to do with base effects. And when a market particular metric goes shooting up because it's been depressed for so long, everyone says, oh, it's just the base effect, don't worry about it. And here I think that it's the high base effect that has affected the market. And do you see that continuing?
Yeah, absolutely. So I'll go right back to basics. So all inflation is the year-on-year change in a basket of goods and services. So if you think this time last year, or particularly earlier this time last year, we were at the height of the COVID crisis and prices were collapsing. So you're seeing these base effects as the year-on-year change is picking up the big increases we've had since those terrible times early last year. However, the real issue in inflation at the moment is you open a factory or close a factory, close a restaurant. When you reopen it, you're as an employee, your demand is there immediately, but the supply side might not be able to actually deliver whatever it may be, sort of foodstuffs, parts for your factory. And so what we're really seeing is huge disruption between the demand for goods and services and the supply of those goods and services. And that's what's really pushed prices up. And so trying to gauge when those bottlenecks will fade is difficult. Most analysts think we are at or very close to the peak, and so they should begin to fade later this year. But it is just because of the totally unprecedented disruption we've seen in the global system. It's very hard to pinpoint that.
Is it the case then that, again going back to basics, that the prices will have to rise substantially in order to maintain a 5% plus CPI level? I mean, if they carry on as they are at the moment, then we are going to slip back and we may go back into the 3.5% to 4% range.
Yep.
Is that the theory? That's
exactly correct. So unless the year-on-year rate of increase is the same, it has to slip. And the way I've been looking at it actually is looking at the 2-year change in inflation, just so and that's actually running at around about 3.4%. So that sort of reflects in the very low prices of this year and the very very low prices of last year and the very high prices of this year. And that's exactly right. Unless we sustain these sort of levels of disruption and price increases, it has to fall back. And most people just think it falls back towards sort of 3% by next year, and that's also reflected in market pricing.
Okay, let's move on to the wholesale prices now, prices from leaving the factory. And that's producer price inflation, 7.8%. It's quite significantly higher than the market had expected, and a little bit of a surprise. And I think the CPI watchers would be saying, well, wait a second, maybe we're a little bit hasty by embracing CPI, because if PPI is at 7.8%, that will be passed down to the retail level at some stage. That's what I interpret it as anyway.
Yeah, and again, I think that's exactly right. If producer prices reflect the cost of producing one unit of goods or services, and that's running up, absolutely. Ultimately, if a company were to maintain margins, and that's of course not guaranteed, but if it were, then that gets pushed through to consumer prices. However, the sort of leads and lags on that are very variable, and it's not obvious it does get pushed through. My understanding of this particular number was it was sort of travel services that have really pushed up in price, and so the inputs into those have increased. And again, that as far as we can see is just a reflection of the big mismatch between demand and supply that we're seeing, and reflects the distortions. But over time, again, I think the expectation is that pulls back. But you're absolutely right. If it doesn't, then ultimately that's going to two things happen. It either gets reflected in lower margins for companies, or it gets reflected in higher prices for consumers.
It's interesting, isn't it? Also interesting is the reaction of the US 10-year bond market. And as far as I can make out, again, as a layman, I look at it and I say, this has got very little to do with the inflation outlook. This has got to do with supply and demand of the bonds, how much supply is being given to the dealers and the general market participants, and how much demand there is for what is being issued. And that's why the yields have fallen quite dramatically, probably around about 50 basis points as we speak from its peak earlier this year.
Yeah, no, that's exactly right. There's two things. When we look at a nominal bond, which is the yield you're quoting there, it's made up of two things. It's made up of implied inflation, and then the sort of real yield, which is the sort of, is the sort of pace at which is compatible with economic growth, if you like. And actually, implied inflation, despite the very high level of actual inflation in the US we've seen, has fallen modestly. So in sort of May, it was at 2.56. And so this is the market's 10-year expected inflation rate. And that's fallen to, well, it got down to a low of 2.20 odd. It's now at 2.38. So firstly, the market's expectations of inflation have actually fallen from the peak, which is very interesting given that inflation is still close to the highs. And that, I think, it just talks to the Federal Reserve being quite hawkish and saying we're not going to allow inflation to take off beyond this. And the second thing is absolutely, there's fears about COVID. We've passed the maximum sort of growth momentum. So from here, growth slows. And don't forget the Federal Reserve for now are buying $120 billion worth of sort of bonds, well, government bonds and mortgage-backed securities every single month. So yes, they're sort of hoovering up that supply. So I think it's a combination of factors.
Okay. And what's your call from here for inflation just to normalise? And what we've seen is we use the famous word from Fed Chair Jerome Powell, it's transitory. Are you a transitory fan?
I am a transitory sort of person. Absolutely. I'm absolutely convinced it will fall back. And the very simple reason for this is that central banks nowadays are inflation targeters. If it's much higher than they expected, the Federal Reserve, not only are they going to pull back on those purchases very, very quickly, and that's in process anyway, they're going to start hiking interest rates earlier than we all think. And as we all know from economic history, as soon as the Federal Reserve do that, they kill the economic cycle. So I personally think that the upside has been sort of truncated by the Fed communication. They're not going to allow this to run away. So, even if it isn't transitory, if you believe they remain credible, then it's very hard to see inflation much above, sort of 2.5% over the medium term.
Very good. Russell, thank you so much for your insight. That's Russell Silverstone, investment strategist at 91 in London. The views and opinions expressed in these podcasts are those of Lindsay Williams and various contributors and do not reflect the policy, position or opinion of any other agency, organisation, employer or company associated with strictlybusinesspodcast.com. Assumptions made on the analyses are not reflective of the position of any other entity other than the speaker or the author. And since we are critically thinking human beings, these views are always subject to change, revision and rethinking at any time. Please do not hold us to them in perpetuity.